Thank you so much, David, for this very generous introduction and for putting up this wonderful conference. It's a little innovative, experimental, what should I say, in many ways, but that's what we need. We need to find ways to communicate and in particularly cross-fertilize industry and academia. And I've interacted a lot with Main Street, let me call it that way, and I learned a great deal from it, because ultimately the people out there in industry and government are the people producing our data. And the wonderful thing is we can communicate with them. We can see what their visions are. Okay, they might have an agenda, and that's our role to uncover those agendas and see what's going on. But that's the role of academics. It's wonderful to be here. It's I've never done a closing talk, but I decided to make it somewhat light by taking 3 topics: crypto, crashes, and credible research. And in all of these ones, I will convey the literature and also my perspective given recent work. I think there should be a pointer here. Yeah, there it is, to roll the slides forward. And I'm going to touch on all of these things, again, at a high level. Crypto. So before I start telling you what I have to say about crypto, this is one of these innovative features. The conference organizers allowed me to ask you a question, and you can give your answer in real time. So Bitcoin returns are either of the 4 following alternatives. They're completely random and unpredictable. They're mostly random, but somewhat predictable. They're somewhat random, but mostly predictable, or, and you guess the final alternative, they're completely predictable. So give me the alternative I think that you think is most relevant. What is the time horizon? Let's say it's weekly returns. Weekly. And now, by some touch of magic, there's going to be a panel appearing on this side of the screen that has your answers.
So you can go into the mobile application, you scroll almost to the end of the sessions to this session, and then at the top, you kind of have 3 vertical lines. You push on that, and it gives you the polls. And so this is the first poll question. So for this session, you go at the top, not the question mark, but to the right of it, there's 3 vertical lines, and that gives you the questions.
I'm making you work. I have 3 questions in total for you. This is the first one.
We have 16 votes so far.
Okay, can you bring up the results on the panel to see what people are responding? It's there, great. So here it is. So most of you think it's mostly random, but somewhat predictable. But there's also contingent that say it's completely random. And I'll tell you what we found. And also, I've been working on a model that takes this idea of Bitcoin somewhat seriously and see how far it gets us as a currency. Like it's just a currency. And I can tell you that Bitcoin volatility in the data, weekly return volatility is 17.9%. That's huge, right? That is creating let's say most Bitcoin returns are in a week are between minus 40% and plus 40%. Huge volatility. Now, what we've done is, given that it's a currency, we've tracked the currency through time and looked at transactional benefits of Bitcoin. There's these remittance payments. There's one big flow of Bitcoin, at least in the early days, from Argentina to Mexico, which was Mexican workers in Argentina. If they, transfer their money to their families at home, they would pay tens of percentages going through banks in Argentina and in Mexico. But with Bitcoin, they can avoid all of that and basically communicate the address of the Bitcoin to their families, and transaction cost is almost zero. But there's other transactional benefits. On a more nefarious kind, there's ways to hide who you are in these type of transactions, and ransom payments are often asked for in Bitcoin for a reason. But from the user's perspective, that's a benefit. Transactional costs are, well, you have to pay miners to validate the transactions. You have to set up a wallet. There's some costs involved, and these costs fluctuate through time. We looked at more of a decade of these returns, and we built proxies for how large these costs are. And with this, based on a model, and calibrating the model, we get to a time variation of Bitcoin required returns of 3.4%. So 3.4% you can get in terms of variation through time by taking Bitcoin somewhat serious as a currency. So mostly, I would say, if I had to judge an alternative, the blue answer is the correct one. It's mostly random, but not completely random. And what's most important when I talk about Bitcoin, and I was even at panels at the time, I warn people for the extrinsic volatility that also comes out of our model. I mean, currency, the value of a currency is based on what people believe about the future value of that currency. Will people accept Bitcoin for payment in the next period or in the future? That's a belief. If collectively we start to think that that's not happening, then the value of Bitcoin will drop to zero. So all of these are in the set of equilibria that come out of the equilibrium model. So when you enter this type of, well, should we call it an asset or an asset class? Be warned that there's a lot of volatility and won't go away. So that's what I have to say about crypto, about Bitcoin. The next topic is crashes. I've been on advisory committees at several regulators, and my work is mostly on securities trading. So high frequency that I'm one of the few that's interested in transactions by microseconds, like latency issues, microwave towers to communicate signal, etc. There's a set of people that are worried about this, and it's highly exciting. But when we talk with regulators, they're okay-ish with the way markets operate, except for when things crash. They're always interested in crashes and understanding crashes. That's when I started, and this is actually what I'm currently working on, thinking about crashes and are there indicators in the market out there that may be predictive of these crashes somewhat. I'd like to think of this, is there a thermometer that sort of takes the temperature of a patient to see if he's ill or no? Now, to tell you what I find, before I'm doing that, I promise you this is the second question. Now you know where to find the answers. The question is, when financial markets crash, and I've looked at 10 of them, from 1993 up until 2024. So the Liberation Day crash earlier this year is not yet part of the sample, but I quickly checked, the patterns are the same. So I've looked at these crashes. When they crash, and these are S&P 500 index crashes, and you can't trade an index, but you can get pretty close to trading the index by trading an ETF. And SPY is a highly active ETF that tracks the index. So you can basically look at trading in SPY in those periods where there's a crash. Now, what do you think is happening in the month of the crash? There's very little volume. Markets are illiquid, meaning transaction costs are high. So basically nobody trades because of the event. Number two, there's little volume, but markets are liquid. So transaction costs are low, yet people choose not to trade, maybe wait it out, I don't know. Or there's a lot of volume, more than normally, but markets are illiquid. So transaction costs are high, still people trade more than they otherwise do. And finally, there's a lot of volume, but markets are liquid because of it. So what do you think is... I'm pretty sure no one saw this paper because it's brand new, so I'm really relying on your insight here. And, yeah, I wonder... Who's typing this question into ChatGPT?
We have 19 votes.
Okay, that's great. That's a nice turnout. I'm happy that so many people participate. So there's lots of volume. Markets are illiquid. Lots of volume. There's a second contingent that says markets are liquid. So we agree that there's a lot of volume. We're somewhat inconclusive as to markets are liquid or illiquid. And I will tell you that what I found in the data is when you look at these crashes, and the 10 of them that I identified in this period, and these are the typical crashes, right? It's the, what I don't have them here, I think. Of course, there's the Euro crisis, there's the financial crisis, there's all of these things that happened in the LTCM, I think, is in there as well. The following pattern emerges. There's heavy selling of SPY on extremely low liquidity. And that is a bit puzzling because in my literature, some people even use this as synonyms, like volume and liquidity. Some people even use volume as a liquidity measure. Here, I use price impact of order flow as a liquidity measure. And bid-ask spreads, even more mundane, or depth at the best quote. On all of these dimensions, there's a lot less liquidity, yet there's a lot of selling. There's a jump in volatility. That's not surprising. You know, for those of you who are academics, we know there's a Garch literature. If you have a large realized returns, then going forward, you can expect larger than average realized returns. That's just the Garch effect. VIX jumps even more. But interestingly, the VIX is jumping to a larger extent, but it's also staying elevated for longer. While the realized volatilities are quickly going down. That's just the pattern of a time series models modeling realized variance. And I've been thinking about this and added an instrument to a standard trading model by Vallanos and Wang to price variance swaps. And if you do that, you get out of it, if you know the price of a variance swap, there's nice work by Peter Carr that says that the VIX squared is a good proxy for variance swaps. You essentially get a value of VIX out of a trading model. And in a trading model, the way VIX is, or the variance swap is valued, is liquidity suppliers like to be on the giving end of the variance realized variance payouts. So they're all happy to pay out the realized variance to liquidity demanders in this period who'd like to be paid the realized variance. Think of it. The model has an unpredictable, in some sense, liquidity shocks for some of the asset managers. You don't know ahead of time if you're going to be called out by your clients to delever, or essentially, reduce risk, but you might, and then you have to. You basically have to delever to stay within the risk budget that the client tells you to be. But then that means that you have to sell this equity position that's turned out to be more risky than you thought, and so you're basically, you're having to trade in a period where it's very illiquid to trade because there's a lot of volatility. Market makers want to be compensated for this volatility, holding that on their books. So you pay a lot, but the upside is you can take a position in the variance swap and then you get paid at the end of the month to realize variance. So you get paid this amount exactly when you need it. So it's a hedge for you as a liquidity demander. And you can put all these things, these moving parts into a model and you get an equilibrium price of VIX based on this trading friction. And it lines up with all these patterns in the market. So that's what I learned exercising through this model. And therefore, I'd like to think of VIX as not so much a fear index, but as an index that is indicative of the extent to which there's going to be forced deleveraging of asset managers, the extent to which there's going to be this fire sales by these managers. But I think we need more work on VIX. I was happily listening into Dan Galai's talk earlier today when he started VIX, and I now see how important why it is, it's getting so much traction in markets. Crypto crashes, and the last C for me was everything is 3 about this conference, right? So this is 3C, is credible research. And this is a very exciting project or line of research that I'm a consumer of, but I also at some point I was lucky enough to participate in a giant experiment where 164 research teams, and I know there's always somebody in the audience who was on a research team, and today there is somebody in the audience who you're not allowed to participate in this question, okay? Because you know the answer. When you let 164 research teams the world over, and this is not PhD students or some sort of people that you pay through the internet, these are serious academics with publications in the top 3 finance or the top 5 economics, PhD in finance. This is a representative group of academics. When you give them a task, essentially, and you give them this data, the sample that's the same for everybody, and you ask them, for example, let's make this a bit more concrete. So you want to take a position to the European equity markets or European equity as a global investors. Where do you go? Well, the most active market is probably Euro Stoxx 50 index futures. It's the equivalent of E-mini in the US. That's where you go. So you take a long or short position depending on what position you want to take. That data is being distributed by that trading is in Eurex, which is part of the Deutsche Börse. And Deutsche Börse has the stated objective to help academics with their data. And so I took them up on it and I asked them, are you willing to sponsor a project where I'm going to ask 164 research teams with your data to compute the transaction costs for transacting in this product, this index futures product, over a 10 years period. And I asked the research teams to do the following. You have all of this data. Now tell me how you think transaction costs evolved over that 10-year period. Did they decline by 3%? Did they decline by 5% per year? Did they go up by 8% per year? What is it? With all the technological changes in our markets, more and more technology marching in, maybe we should expect transaction costs to go down, right? But what is it? And so we asked that question to all these teams, and we got the reports. Now the question to you is, if I have 164 numbers for this transaction cost percentage annual change, what is the interquartile range for the outcome? Okay, 164 research teams file with us their estimate. What is the interquartile range across all of these teams? Is it small, less than 1%? So if everybody is between 3 and 4%, let's say, then the interquartile range is less than 1%, and I consider that small. Is it moderate, 1 to 5%? Is it large, 5 to 10%? It's a very simple exercise we asked them to do with the same data, again, like to emphasize that. Or is it extreme, more than 10%? What do you think it is? So for those of you that participated, please don't vote. Not contaminate the results.
16 votes so far.
Okay. Let's see what they are. So most people think it's large, 5 to 10%. Some people think it's moderate. Now let's see. Most people think it's large. Then there's a second contingent thinks it's extreme, more than 10%. Then we have small. So we're all over the place, which is kind of nice. I will give you the result because I brought that slide with me for this presentation. This is how much, this wasn't a Dutch experiment. I'm a professor in Amsterdam, but this wasn't my buddies in Holland. We basically we did a massive campaign to try and make sure that we target everybody around the planet. Most people's were coming from the US, but the decent representation in Europe, Australia. I mean, it's basically where you expect people to be, roughly, with the densities roughly right. So this is the dispersion in estimates. We asked them to estimate 6 objects. I was talking about transaction costs. So I'm going to highlight that. That's going to be this one here. Realized spread is a measure for that. And what you see on the left-hand side is a geometric scale. Let me emphasize that. It's what people report as annual percentage change in transaction costs. I plotted all the individual 164 points here, the black dots, but the interquartile range is represented by this blue box here, where the bottom of the box picks up the first quartile, the top of the box picks up the third quartile. And people are close to 10,000% for some of these things. They report that. But I deliberately picked the interquartile range because I don't want this study to be focused on the outliers. I mean, there's always people that have extreme ideas anywhere in societies. But I'm interested in most of the people. That's why I take the interquartile range. But even the interquartile range is the lower side of this blue box is maybe -7, -8%. The top side is +7, +8%. So it's more than 10%. And that's extreme for arguably relatively simple measure, the realized spread on transactions. But more intriguingly, some are south of the horizontal axis, some are north of this axis. So some people believe transaction costs have gone up. Some people believe transaction costs have gone down. And these are, when we talk about -2% or +5%, these are really large differences. And so we wrote the paper, we branded it initially as crowd-funded academic research, but we turned it into a deeper message and we called it non-standard errors. The interquartile range here is a non-standard error, meaning that is an uncertainty that's associated with any empirical research, any quantitative analysis. I mean, in the newspaper you read this morning, if it had a graph showing some numbers, somebody did some analysis to produce those numbers. Had somebody else done the analysis to produce those numbers, would not have gotten the same numbers. And we tend to think that these differences are small, but when you do empirical research, and for those of you who do, you know there's so many decisions that you take along the analysis paths, and we'd like to call them forks. So there's so many forks, like what do I do with outliers? If I remove outliers, what is the cutoff level? What statistical model am I going to use? For futures, am I including rollover periods or am I not including rollover periods? There's so many, and each one we understand, will have some effect on the outcome, but never have we seen evidence on how they accumulate. So what is aggregating across all of these forks? And how much of a dispersion do we get? Is it anything substantial? In our case, it was sort of even larger than the standard errors that people reported. And we called it non-standard errors with a wink towards standard errors, because standard errors is a level of uncertainty that's coming from picking a finite sample from a population, right? Next time you pick a sample, it's different, and so you get sampling error. Here we pick a research team from a population of research teams. And there's something to say for all of these analysis paths, but you tend to find the best that you think, the one that you think is best. And then we have to be mindful that anytime we look at empirical results, that this is one draw from a research team. And ideally, you want to do this experiment with every research question out there. But that'd be a bit prohibitive, because we calculated the back of the envelope how many man-hours went into this project. We had 164 research teams consisting sometimes of 2 people. There was referees, not referees, that's the wrong word, evaluators, evaluating people. We had multiple stages of research essentially simulated in this experiment. So that made 350 people busy for a couple of months. If you add up all of those numbers, you have an entire academic career put into this single paper. But I'll tell you that, okay, I'm just going to summarize non-standard errors. So analysis requires picking a route in the garden of forking paths. I like that. The garden of forking paths. So you pick your best path through this analysis path through this garden. Different routes, different outcomes, uncertainty. Human cost of computing the non-standard errors seem to be prohibitive, right? We can't do this all the time. But, and I've seen early work last week at the European Finance Association meeting in Paris. There was a really nice paper, a couple of papers, but one that stuck with me by Mikhail Velikov on using LLMs, large language models, to simulate humans doing particular tasks. Well, if they can simulate me, if they can simulate David, if they can simulate you to some degree, we can compute non-standard errors without getting everybody, I mean, this is deliberately provocative, it's just the final talk, but without any engaging any human, right? So, and on that note, there's this really neat paper that I'd like to advertise by Novi, Marx, and Velikov, where they essentially let the LLMs, as I understand it, I have to read the paper still deeply. So you have an asset pricing all of these papers that try to look for anomalies by parsing accounting data and then doing all these standard tests, the sorting, the regressions. So they let the LLMs do those tasks, but they didn't stop there. They asked the LLM, why don't you write the paper around the anomaly that you just identified? They asked the LLM, it'd be nice if you give it a cute name, because then people remember that paper. Put that name on top of the paper, write the abstract, write essentially the entire paper. So Michael told me that they wrote 288 papers. They let the LLMs write 288 papers on something short of 100 anomalies. So for every anomaly, they asked the LLM to write 3 papers with 3 different anchoring in the literature, 3 different sets of tests, and the discussant, Amit Royal was the discussant, he read a couple of these papers and he thought, wow, okay, they're probably not publishable at the very top of their field, but it's not so easy to decipher that this was produced by an LLM. And there you go. I mean, this is, so I asked Michael if I could basically steal 3 of his slides, because first slide I stole from him is this one. This is the paper, AI-powered scholarship, AI-powered finance scholarship. This was what he hoped the world to be in the future, that the LLMs would do the academic work for him and he could spend time doing what he liked best. And then one thing that he mentioned, that this is not some sort of vision of the future. Maybe it's already happening, at least parts of it. And there is this paper in a environmental science and pollution research, which is not a top journal, but it's a decent outlet. Where and this is the abstract of the paper, and at the end of it, it says regenerate response. So apparently, I mean, one thing that could have happened here is that the researchers asked ChatGPT to maybe polish the abstract, but copied over that entire thing. But in ChatGPT, you've got this button that says regenerate response. They forgot to delete that, and it's even in the printed version of this paper. So it's amazing. And he had a few more of these examples. And anyway, it was fun listening to him. So let me conclude here, because my time is 20 seconds. So crypto, 3 topics, the 3 C's, right? Crypto, volatility. Volatility that's extrinsic in nature, it will always be there. And share that warning to all of the people participating in these markets. You're not going to see volatility disappear, at least from a basic currency model. Crashes. Maybe VIX is a useful index for people that are worried about prudential risk or system failure risk. It's a measure, this liquidity model, of the extent to which investors might have to sell when the markets start to crash. Higher VIX is the more of that is taking place. Either more investors have to sell in these periods, or on an intensive margin, there might be the same ones, but they have to sell more. We don't know. And finally, credible research, and that's non-standard errors, is another source of risk. Not risk, uncertainty, another source of uncertainty that we should be aware of. We know about standard errors, but anytime you read an empirical paper, or you see a report, or read your newspaper, magazine, what have you, wherever there was a quantitative analysis, lots of decisions were taken. And I'd like to argue those non-standard errors, the uncertainty of having a particular team pick it relative to another team from the same population do the same task, that certainty is something to be mindful of. It's large. It's at least as large as standard errors as we measured in this particular experiment. So with that, can I give it back to you, David? Thank you so much in participating with the 3 questions.